Imagine waking up tomorrow and finding out your country just got poorer overnight. Nothing exploded, no war, no crash on the news ticker, just one quiet change. Interest rates moved up by 1%. That single number is enough to make governments panic. And there's a reason they never explain clearly, because once you see the math, it's uncomfortable. Right now, this matters more than almost anything else. Across the world, interest rates are no longer free money. They're rising, slowly, reluctantly, but relentlessly. And every government knows what comes next. Let's rewind. For years after the 2008 financial crisis, interest rates were pushed close to zero. Borrowing was cheap, painfully cheap. Governments borrowed, companies borrowed, households borrowed. Debt stopped feeling dangerous. It felt normal, responsible even. If money costs almost nothing to borrow, why not use more of it? That's how modern governments started operating. Not like a household that saves first, but like a machine that constantly rolls over debt. Here's the simple version. Governments don't pay off debt the way you pay off a loan. They refinance it. Old debt expires, new debt replaces it. Over and over, year after year. As long as interest rates stay low, this works. The payments are manageable, the system stays calm. Now comes the part that causes panic. When interest rates rise, governments don't just pay more on new borrowing, they eventually pay more on almost all existing debt, because that old debt has to be renewed at the new, higher rate. A 1% increase sounds small. It isn't. Take a country with $10 trillion in debt. A 1% higher interest rate means roughly $100 billion more in payments every year. Not once, every year. That's money that doesn't go to schools, hospitals, infrastructure, defense. It goes to interest. And here's the cruel irony. Governments don't control interest rates the way people think they do. Central banks raise rates to fight inflation. That's their job. Cool the economy, slow spending. But governments are the biggest borrowers in that same economy. So when rates rise to fix inflation, the cost of running the country rises too. It's like trying to lose weight while someone quietly increases the price of food every week. Now the math starts squeezing. To cover higher interest costs, governments have only a few options: raise taxes, cut spending, borrow even more. None of these are popular. All of them slow the economy. This is why officials speak so carefully when rates move, why press conferences feel tense, why markets overreact to single sentences, because everyone understands the fragile balance. There's another layer most people never see. Higher interest rates don't just affect government budgets, they reprice everything. Mortgages, business loans, corporate debt, stock valuations. When rates rise, future money is worth less today. That's bad news for assets built on future promises. So while governments are paying more to survive, markets are repricing risk everywhere else. That's when panic spreads. And then comes the political problem. Voters feel pain fast. Higher loan payments, slower job growth, budget cuts. But the cause feels invisible, abstract, technical. A 1% interest rate move doesn't sound like a crisis until you realize it quietly rewrites national priorities. This is why governments often hope inflation fades on its own, why they pressure central banks behind closed doors, why they delay hard decisions, because higher rates force honesty. They expose how dependent the system has become on cheap money. For years, low rates acted like anesthesia. They dulled the pain of debt. They delayed consequences. Now, the numbness is wearing off. And here's the uncomfortable truth. A 1% rate move doesn't just change budgets, it changes power. Who gets funded, who gets cut, who survives downturns, who doesn't. That's why governments panic. Not because they don't understand interest rates, but because they understand them perfectly. So the real question isn't whether rates will move again. It's this: how long can an economy built on cheap debt function when money stops being cheap? And when the next 1% comes, who will pay for it?